Happy Monday to you. This is November 24th. My name is James Boyd. Feels like I've been gone for a while. We'll talk about that in just a moment. We welcome everyone on this Thanksgiving week. Just so I don't forget, I want to wish you happy Thanksgiving with you and your family. My parents actually moved out to Utah, so this is the first time in 30 years that our entire family will actually be having Thanksgiving together in over 30 years. So it'll be interesting in the Boyd family household. We'd like to welcome also many of you here as well. Gary, Silas, Bill, hello, David, Lido, Len, and JP, Kevin Baker, and many others. We also have Rachel Dasher with us in the chat. We welcome her as well. And a quick reminder, yes, have a happy Thanksgiving. Now, I want to kind of just quickly say something real quick. Number one is I will not be going on any more week-long vacations until May of 2026. Now, last March was the regional bank crisis. I was gone for that week, regional bank crisis that week. Last June, I actually took a week off, went to Kentucky. It was actually non-eventful. We also saw this early March. I stepped out for 4 out of 5 days of the week. Then we actually had the tariff crisis. And then this last week, let's just call it volatility. So I have been a pretty good indicator. Now, I'm not saying the market knows I'm out, but I have been a pretty good indicator. When I'm out, for some reason, the market just wants to go down. It's less than a 0.5% chance that I actually could do that, but I've been pretty good as far as being a potential indicator. Speaking of indicators, this class is called Trading with Technical Indicators. I want to get into some of your questions, so let's go ahead and hop right in. Now, remember, you could follow Rachel and myself on X. We do post educational content there and announcements as well. Also, quick reminder that with what we discuss, we do talk about this from an informational purposes only. Should not be considered an individualized recommendation. Also, remember that options carry a high level of risk, are not suitable for all investors. When we talk about examples, we will do those in the Paper Money software application. Understand that investing involves risk, including loss of principal. And today, what I want to really kind of talk about is some of the questions that you actually have. So after a couple questions are, after a sell-off, what do you look for to try to get back in? That's going to be a major topic. After a sell-off, what type of strategies might the investor consider after a period of higher volatility? So I want to kind of hit those head on. Now, just real quick, when we kind of go into this, I want to kind of start with something just really quick, okay? So just because I was out doesn't mean I was out, I didn't look at the market. I looked at the market as much as I was here at the office, okay? Saw the whole thing, okay? Now, I do want to kind of make mention of something that I want to at least kind of point out here, is I want to kind of think about maybe your strategy, okay? So on the left-hand side, we actually have volatility, and on the bottom here, we call it expected return, okay? Now, I don't know how you position your portfolio in the Paper Money account. I don't know. But I want us to kind of imagine that you said, James, I got 100% of my portfolio, and it's in stocks. Well, when you got 100% of your portfolio in stocks, let's just leave it there for just a second, and the market becomes volatile, you're going to see that you are way up on that y-axis, okay? You can be extremely volatile, okay? Now, here's the deal. If those stocks are, let's say, tech-related, we'll look at those in just a sec, they are discretionary related, and you say, my whole portfolio is in technology and discretionary. Boy, talk about a bull ride, okay? Buck and Bronco, all over the place, okay? Now, so if this is why we kind of say the portfolio really is trying to have minimum 3 to 5 sectors. Why 3 to 5? Why not just 2? Why not just the 2 that are more volatile? Well, because when there's pockets of volatility, if the whole portfolio is actually in those 2 areas by themselves, man, a little pullback of 5% can feel like a complete bear market in a very short period of time, okay? So now this also kind of brings up another point. Well, I wonder if I have domestic stocks and maybe I have some other things that are not here in the U.S. Well, you got to remember there's still correlation, okay? Now, I want to kind of just point this out. If someone said, James, I got a portfolio that's 80% stocks, 20% something else. If I have a portfolio, let's say 70% stocks, 30% something else, or other things plural, I got 60% stocks and maybe let's say 40% something else. Why is the curve going lower? Well, because stocks are risky. And if you said stocks or derivatives or whatever, they are both risky. Why do people like them? They have higher, the key word is potential returns. But if you can go up 20%, you can go down 20%. Okay? So now the question I actually have is, where are you on this curve? Are you an investor that says, James, I'm 100% all the way over here? Well, after last week, is that where you really want to be? You said, James, I kind of think I'd like to kind of move to maybe where I have some diversification. Okay, this is a great opportunity to actually learn about that. If you said, James, I'm 80-20, or I want to go 70-30, or I want to go 60-40, when you have market pullbacks, you should think about your strategies, okay? Because the past can keep playing itself out sometimes, and you want to learn from that. Now, I want to kind of bring this up, and I want to kind of talk about some of these things, and I just want to say one more thing with this. When we talk about, for example, the market when it sells off, we always kind of talk about a 1, 2, 3 method as far as selling. And we'll hit that in just a sec, okay? So, and we're talking about exit signals, okay? Good old exit signals. Exit signals, all right? Now, last week, it was just red, 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 and more red, okay? So, man, when those selling signals came on, it just kept going down. Now, the other thing is, maybe the second thing you actually maybe thought about was protection, okay? Now, that protection, okay, it can really be, and I'm just going to say it like this, if we have a stock position, we're probably going to need 40 shares of stock to be able to probably buy a put. Why is that? Well, because most of the puts we look at would be out of the money. So if we have 40 shares plus of stock, not 100, okay, less than 100, let's say 40 shares to maybe, let's say, I don't know, 75 shares, just less than 100, okay? If we bought a put, like an out of the money put, that delta would probably be about 30 to 40, okay? So is it going to hedge the entire thing? Probably not, but it might at least be a hedge, okay? So when I say protection, I'm talking about buying a put, okay? Buying put. Now, is that realistic if you said I'm a stock investor and I buy puts? You might not buy puts all the time, but when that volatility actually goes up, you probably know that there's a good chance that stock goes down. Why not just sell everything? Well, because you might want to try to have some positions that you're holding over time, okay? And there's other reasons for that. Third thing is actually when we do this is, obviously we're talking about collar. Now, I'm not going to go into that, but when we actually talk about collar, this is where we're talking about 100 shares plus, okay? Now, the other thing is with this is you might say, James, I saw the market going down, and I actually maybe put on an index hedge. Usually when I say index hedge, you might say, look, I went bearish, the S&P 500, the NASDAQ, the Russell, and so on. Probably one of those three. The fourth thing in this order is probably just bearish positions. Bear positions in this order, okay? Short call vertical, long put vertical. Now, why not put on the bearish position first? Well, because you're trying to protect you're trying to actually protect what you have. You're trying to pay attention to what are the positions you actually have and where are those signals likely going to come in, okay? Now, the one thing I want to kind of say with is that step number one, if we talk about 1, 2, 3 exit signals, the exit signals most likely are going to come from the technology sector and they're most likely going to come from discretionaries. I also want to highlight asterisk short options, and I'm going to say short puts. That is in step number one. Why is that? Because if the price goes down and the volatility goes up, it can be double whammy of pain. So when I see the market volatility start to go up, I'm thinking, hey, these sell signals of 1, 2, 3 methodology, if they're tech stocks, discretionary stocks, they're probably on a percentage basis going to lead to the downside. And what is in the sample portfolio that is short puts? And are you okay with owning those shares? Because it could get ugly in the short term. Now, some people, they might say, James, I'd like to just maybe have 1, 2, 3 short puts. Why? Well, because they might want to say, I want to kind of keep some capital available to try to buy things maybe at a lesser price or sell puts after maybe that volatility has peaked, okay? You're probably not going to nail the top all the time. Some of you probably could, but you're just trying to say, look, I want to have some capital after the sell-off. Now, the last thing I'm going to kind of point out on this is if you said, James, I don't do 1 through 4 at all, I am what I call a B and H. What does that mean? It's just a buy and hold. You are just weathering the volatility. Okay, now in this portfolio, we kind of try to show examples of 1 through 4. All right, so that's really what we kind of talk about. Now, notice the bearish positions, they don't come in until after the investor's looking at current positions, protecting maybe what they have with a long put or maybe a collar after a long hedge. Okay, and by the way, that could be an option strategy. It might be something else for you. And then fourth, a bearish position. If someone is actually saying, James, I'm a number 5, buy and hold, you might have more of an intermediate to longer term view. That's not a bad thing. You're just saying, look, I'm willing to accept that volatility to try to have an allocation to the trend and that asset class and try to ride the longer term type of trends. I understand. So that's why I want to put those there. Now, if I actually go back to this, okay, so let's kind of talk about now that we kind of have some of that context, I want to go back just real quick to let's start with the SOX. The SOX here, just kind of notice, this was our diagonal line, right? Let's fast fire through a couple charts. Once we broke through the diagonal line, the moving averages have literally been red except for one day on the shorter term moving average. That is what we call number 1. You never had the 20-period moving average go red. You never had the crossover. So really, since the date of the 12th, the moving averages have been red. And what does that say? Sellers are in control. And by the way, if you're a bullish investor like many people are, you have to know when to say no. It's not giving me a signal. And I'm going to stick with that. So if the investor says, well, James, I got red, okay, red, that's not my signal. The investor says, that's not my signal. But we were up in the morning. It doesn't matter if we were up in the morning. Because if we're up in the morning, it doesn't mean that we have a step 2 or a step 3. We're up in the morning just means just that. We're up in the morning. That's it. It hasn't changed the trend yet. Do you know why you're waiting? Well, why are we waiting? Well, the investor is actually looking for a sell-up. And if they're going day by day and they're saying, I'm still seeing the red shading, which means the 10-period moving average below the 20, sellers are still in the control. Now, here's the deal. As a bullish investor in the short term, if the investor has some positions, this is not the funnest part of investing. It's just pulling back. Sellers are just knocking this thing, pushing it to the downside. And you're thinking to yourself, Mama mia, where's the bottom? Okay, tap out is what some investors are thinking. And that's why you get volatility spiking sometimes, because people say, look, I didn't buy the puts when they started to go up, but now I can't take it anymore. And they just start buying puts, and it knocks the VIX to the upside. And you got to remember one critical point we're going to make here. The higher that the VIX goes, the more expensive the protection becomes. It also becomes a lesser probability of being profitable. So that's why a lot of times you get mean reversions or channeling type setups. Okay? Now I want to kind of say that. This would probably be a good thing. If this is being recorded, I'd go back and listen to this like 3 times. Okay? I've been in the market almost 30 years. I've seen a lot of pullbacks. I've wasted so much time on just pullbacks. This is why people want to start with good quality stocks and have an understanding of kind of that 1 through 5 steps that we discussed before. Now, let's kind of talk about the questions that we actually had, okay? So when we talk about, let's say, the SOX, I still don't see, and this is the question, okay, from you. After a sell-off, what is the investor looking to see to get back in? Well, number 1 is we're looking for a horizontal support level. Now, if you look at the chart on a maybe 1, 2, 3 month basis and you can't see a horizontal support last 1, 2, 3 months, that's not a good sign. Second thing we're actually looking for is a bullish MACD divergence. And then from there, the investors should really be starting to actually see like a diagonal breakout. So after a sell-off, I want to see the price come down to a horizontal support level. When the price actually falls down to that horizontal support level, the investor is normally going to be seeing, in this case, bullish MACD divergences. MACD divergences. If we actually start to get the price to start to go up, the price should start to become greater than the diagonal resistance line. And this is where you go from really trend 2s to trend 3s. So it's not just the price falling down. We want the price to fall down to a horizontal support level over the last 1, 2, 3 months. It should be identifiable. So if you're looking for a magnifying glass and you can't see it, that's not a good sign. So when I say 1 to 2, 3 months, so how far do we look back? Go back the last 1, 2, 3 months. Can you see a horizontal support level? If I start to see the horizontal support level, we start to get a bullish MACD divergence. And I'm talking about a bullish divergence. From that bullish divergence, if we start to get the price, can we get the P for price? Is it greater than diagonal resistance? And all of a sudden you start to get really trend reversals. Okay? Now, let's kind of take a look at this. Now, by the way, is it possible from here that some of these stocks, they never even really pull back? That in other words, there's still some relative strength stocks that have held up near the highs. Is that possible? You better dadgum believe it. And we'll show you a couple stocks here today. But this is kind of some of the framework that many investors have seen pullbacks before. This is what they're thinking, okay? Now, I do also want to kind of point out one other thing is when that price is below the 10-day moving average, okay? That 10-day moving average, we kind of always talk about maybe the question mark there, pain. And that's why we say that. If the price gets below the 10-day moving average, there can be lower lows and lower highs. And if the investor is long and they're not exiting, oh, it can feel so painful sometimes. Okay, that's why we say that. Now, let's go back and kind of talk about kind of some of these examples. Now, when we take a look at some of these positions, I want to kind of start with, now this kind of depends upon what type of investor you want to be, okay? So remember the fourth thing that we just brought up there is there some stocks that maybe are showing relative strength. Now this should be like just light and darkness here. It should be so evident. In other words, if I pull up a stock, which I'll show a couple, there should be like if I pulled up Apple and I said, does Apple look like the market? No, it doesn't look like the market. Does it look like the sector? Well, you can pull it up and see it. No, it doesn't look like the sector either, okay? Well, now this kind of brings up the question, what type of strategy, okay? Now, I don't know about you, but when I first got started investing and I didn't have any coaching, anything like that, man, after market sell-offs, I was scared. I was nervous. Why? Well, because when things pull back, you typically have drawdowns. And after you have drawdowns, the last thing that you typically want to do is to be the first one back in and risk more capital. I mean, you can kind of see the point there. Now, strategies might be, for example, something that has defined risk. Like what? Short put vertical, okay? It could be a long call vertical, okay? I'm also going to include here, in this case, a caller, okay? And we know that that is a stock position with a short call and a long put. These might be the three strategies that some investors say, look, if I get a sell-off, I'm going to pick strategies. This one probably maybe first some investors might consider. Why? Well, because it's higher volatility, bigger credit. Bigger credit, lower break even, okay? This one actually has a higher potential upside typically if you take kind of the usual criteria of selection. And this one is stock-based, okay? Now, the question came up before is why when you put on a position, and let me actually say that because I'm going to put this example on in just a sec, okay? So let's say the investor said, look, I want to do a short put vertical thinking that the price could break out to the upside. All right. Now you might say, well, James, I'm going to wait until we break out. That's how you might trade this. If the investor says, look, we're already getting a push to the upside, some investors might buy some, even though it hasn't broken out yet, and then try to add. In my experience, when someone says, I'm going to wait for the breakout, and I don't know. I don't know. I don't see their trades. But the biggest actually thing is the question is for that investors, does the investor really follow through? I think for more investors than not, they might say, I'm going to buy some inside the channel and I'm going to try to add potentially if it breaks out. That might be a little logical because there's a little dollar cost averaging and not everything is based upon one moment in time when it breaks out. But it seems like more often than not, perhaps, that maybe when it finally breaks out, they missed it, okay? So what I'm going to do here is I'm going to go to the paper money account. Trade number one that we're going to look at here is I'm going to go to, for example, the Apple, and I'm going to pull this up here. I'm going to look at the example. Now, forget the position down below, okay? Matter of fact, we're going to go to the margin account, and where there's no position, we're going to go 20 to 40 days to expiration. Now, here's a question for everyone, okay? If this class in the pay money account said that they were more optimistic upon the price breaking out, would you sell a 20 delta put, or would you sell something like a 275 with a 44 delta put? What would you do? If you were more optimistic on the price breaking out to the upside. Well, if the investor said, James, I'd sell the 275. Well, the bigger credit, okay? You get a bigger credit because there's a greater chance of the stock being below the strike price. Now, this class is on trading with technical indicators. Are there any indicators on this right now that is kind of showing us maybe, is there any price pattern, a trend, anything? Candlesticks? Well, the MACD has almost gone to zero. It hasn't gone to above the zero line yet. That's a bullish engulfing right there. That's your close above the high of the low day, which we have not seen in a couple days on many stocks. What step are we on in the 1, 2, 3 methodology? Well, it's really 10-day moving average, 1, 20 period moving average, 2, and you see that we're kind of pinching. We're not 3. We're kind of in that middle. Step 2, in other words. That waiting for 3 is kind of the more confirmation. The deeper you wait for the confirmation, that just typically means the stock could be more off the support level. Remember, confirmation isn't free, okay? Now, what I'm going to do is I'm going to go back to the trade, and we're going to go look at, for example, to sell the 275, and what we're going to do. Now, what strike you buy will be dependent upon, for example, in this case, how many contracts you can do. If you said, James, I can risk $400, well, we wouldn't be doing a $10 wide spread then. If we said, hey, I can do risk maybe $800, we probably would do a $10 wide spread, assuming that there is liquidity on those strikes. Now, example given. Let's say we're in the margin account. Let's say we're willing to risk 1% of the balance. So 39,000. If I risk 1% of that balance, about $390. The question now becomes is, could we do one contract? Is $330 less than $390? Yes. How many contracts could we do? We could do one contract. Now, a lot of times when the market pulls back, investors think, well, now we're going to do something completely different. Why? Why? No, we're going to go right back to it, okay? So it's not changing the plan, okay? So if the market's going up, we tend to always look for relative strength. When the market's going down, we're going to still get relative strength too. Now, I'm going to mix some of the stocks we actually look at so we can kind of talk about some stocks at horizontal support with bullish divergences. But trade number one, we're going to do in the margin account, the 275, 270, okay? Short put vertical for December, the 19th of December, and that's the max profit. Now, I'm going to also go into the IRA account. In the IRA account, if you said, hey, James, I really want to kind of do something where I could have a higher potential gain. Now, I'm going to right-click on this 275 right here. I'm in the IRA account. I'm going to come over here, buy vertical. This is a long call vertical. I'm going to do the 275, 285. Why are you doing $10 wide? Well, because if I did a 0.5% or 0.75% of that balance, we could do a $10 wide strike. Now, if you look at this real quick, you're going to see a debit of 463. That's what we could lose given the vertical, okay? Now, what you're now going to notice is we have a $10 wide spread. We're paying 463. The difference between those two is 537. That's the potential, the debit is the potential loss. The potential max gain given the vertical, 537. That is not including the commission. So you got to subtract that $1.30 off to see what is the potential. Okay. Now, if we take a look at that, now you're going to see that if we do lose the 463 and the commission, that's what we get the total there. Okay. Now what I'm going to do is I'm going to send that. So in the margin account, we did a probability-based trade, okay? It was a little bit more aggressive. Why? Because we sold the at-the-money strike, literally at the money. Why would someone do that? They're more confident that the price might break out. Do they know for certain? No, they don't. They're just going for it, okay? Second, in the other account, the IRA, in the paid money, we actually did a long call vertical. Some investors like to kind of think of that higher potential gain, but you got to remember, why is that the case? Well, you got a higher break even. Okay, and you don't have that positive time decay. Now, I want to kind of also take a look at another stock, and I want to kind of look at something. I'm going to go back to the example, like just real quick. I'm going to go look at just really, let's go shop for just a second, okay? Now, one of the comments we made before, let's go back to this. So when markets sell off, what is the investor looking for? Simple. The investor's looking for stocks where they've fallen down to horizontal support level. So like last week, when you looked at many stocks, why do the prices keep falling? Well, the bullish investors who are wanting to buy, they're saying, look, the prices aren't at horizontal support level yet. And they think the prices could fall further. That's number one. Number two, if the bullish investor's waiting to get in, they're trying to time their entry on seeing bullish MACD divergences. These typically take 2 to 3 weeks to set up. This is not an expectation that it's always going to do that. This is just probably the average, okay? So when things pull back, they might pull back for 2 to 3 weeks to finally get a bullish MACD divergence. Now, let's go back to this chart for just a second. If you look at SHOP when it topped out, and here's the thing, I don't know if you've ever looked at this, but when you go back and look back, you're like, dadgummit, it just seems so easy when you look back. I mean, when we crossed over right here, it was Katie barred the door to the downside, okay? When it crossed over to the downside, this 20 period moving average right there, it was just as red as it can get. And it went down, 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 down some more, Adrian. That's what it felt like, because the bullish investors were like, wait, my stock was 180, now it's 140, but it's a good company. Well, that doesn't really matter if there's more sellers than buyers. When prices are going down and gapping down, sometimes you can have an irrational behavior. Emotion sometimes could be more stronger than logic in the shorter term, okay? Now, in this case, what you're going to notice is, has the price fallen down to the horizontal support level? I want to see it myself. So if we go back and look at this and says, is there some area of horizontal support in the last 1, 2, 3 months? Some area. I mean, this area we went lower than. That area right there, yeah, a little bit more, and a little bit more. So are there some areas? Yes, we could say that. Okay, now step number one. Now number two, we come over here on the right-hand side. Can we see a divergence? Now, when I see a divergence, we're just kind of circling, where do we actually have the lowest peak first off? So that lowest peak right there, we get redder. If we see the histogram bars going down and they're the lighter red, that just means it's below the zero line, the histogram is, and the MACD bar is worse off than the previous day. The burgundy, it means we're still below the zero line. The histogram bar is, but it's actually not as bad as it was the previous. It's stronger, less bad than it was the previous day. And you actually look at this kind of, again, I'm circling where we can get that lighter red, darker red. And I'm asking myself the question, and by the way, it's not bad to talk to yourself. Someone told me once that if you talk to yourself, you could have an above average IQ. I can't confirm that, but maybe. But if we take a look at this, that is a divergence so far. Now, let's go back to strategy for just a second. The investor says, hey, I see a number 1 on the 10-period moving average. I see a number 2 on the crossover, and I see the 20-period moving average Friday crossed over. So the 1, 2, 3 method is still there, but it's really kind of backed up really more by horizontal support and also a divergence. Now let's talk about strategy selection for just a second, okay? And this goes into some of the questions I actually got. Now, how many of you have ever said, James, after the market sell-off, I know I should be looking for opportunity, but I'm nervous to get back in. I'm like you were, okay? Well, okay, so let's go to strategy for just a second, okay? Well, if we look at, let's say, strategy, and the investor said, I'm going to go in and I'm going to look to try to do, I'm going to buy, and this is probably like far as liquidity, probably not the greatest example, but we're going to use it anyway. We're going to look to, let's say, buy the shares of Shop. Now, if the investor buys the shares of Shop, well, in this case, it's the most bullish thing you could do. You outlay the capital and your delta is 100, okay? Meaning you feel 100% of that stock movement up and down, okay? Now, what we're going to do is we're not just going to do the 100 shares by itself. We're going to sell a call. Now, wait. When you sell a call, what have you just done? Well, you've capped the upside. Boo. Well, don't say boo. Some people don't mind to do that, okay? Now, the question becomes, would you want to cap the upside at 155? Now, the investors say, wait, this doesn't make any sense. We're buying the shares at 154.92, and you're going to cap the upside at 155? Would you do that? Well, you're going to have 8 cents upside. Matter of fact, we're back at 2 cents now. Probably not. The investor might say, look, I want to have a little bit more upside than that. Maybe sell the 160. Now, why did you skip to the 160? Because there's no open interest in the 157.5. There's no open interest on the 162.5. And if we go to the 165, there's more upside. With the more upside, there's less what? Premium. Now, whenever we talk about doing a buy right caller, we talk about selling the call and buying the put with minimum 20 days expiration. Check. We talk about selling the call, buying the put with the delta 30 to 40. Does it always have to be like that way? No, but it's a starting point that we look at, okay? Why the delta 30 to 40 on the call? Well, because you have some upside on the stock, okay? So now if I actually click on, let's say, the 165, we get from 155 to 165. Now, this begs the question that's been asked by Jeffrey. Why don't you just use the profit loss on the monitor instead of kind of old school fashion figuring out the maximum gain, maximum loss? It's more of a teaching tool. It's also from the standpoint is that we haven't done the trade yet, and I want to know what the max gain is, max loss, before we get into the paper money example. Now, after we get into the trade, now, by the way, I would want to know what is max gain, max loss. If we can't figure that out, it's probably going to be tough to manage the position, okay? The reason why we actually like to kind of do it is it's a nice teaching tool. Now, if we come down to a delta 30 to 40 on the put side, it's going to be the 150, okay? Now, let's draw this out for just a second, okay? Let's stay on this page. Now, again, everyone should be able to do it. Basic math here. So there's no calculus here, okay? So we don't have to be scared. I'm going to say that we're going to buy these shares at 155. Why are you doing that? I'm just going to try to make it easier math, okay? Just go to the dollar amount, okay? We get up to 165. That's where the investor agrees from now until expiration, not just expiration, to agree to sell those shares at 165. Now, you want to agree to do that for free? You say, give me some premium, okay? That's why they're giving you a premium, okay? Now, part of it. Now, the biggest actually thing is that's the upside. We know that there's $10 there. Okay, so let's just leave it there. Basic $10, I should have lost nobody. On the downside, I'm going to draw it down here. Okay, where am I going? 150. Okay, 150. Where'd you get the 150? Right there. So if we buy the shares at 155, we have a right to sell them at 150. It's negative $5. All right, now, what do we got to figure out? The question now has become, in this case, is are we paying more? Is there a debit or a credit? Well, we get 440, but we're actually paying 620. So that is going to be a debit. So really, the $10 is the stock. And in this case, I'm going to write a D for a debit, meaning we're paying $1.80 free commission. So the maximum gain upside in this trade is $820. The S stands for stock. The D stands for debit between the call and the put. Okay? Now, what about the downside? Well, the downside, we know that the stock could lose $5. Let's write S for stock. But you got to remember, that's not all. Okay? We're also we have a debit of $1.80. $5 from 155 to 150, and the debit, that max loss is $680. So why don't you just look at the numbers on the, let's say, the monitor page and have a column where it says PL percentage? Well, that's after we do the trade. But I still want to know it. Even if I put on the trade and we had that column, I'd still want to be able to run the numbers in my head, okay? If we can't run the numbers, why on earth are we doing the strategy? Okay, kind of says we haven't done our due diligence. Now, in a type of trade like this, there's a little bit more potential upside. So the buy right put strategy or collar, it is really long call vertical like in terms of max gain, max loss. The gain is bigger to a degree because you own the what? Shares. Okay. Now, what I'm now going to do, now, Jason, I noticed something. You're not talking about buying stock and buying puts. That's dang right I'm not. Okay. Now, the investor might do that. Why are we not doing that? Why? Well, it's because the higher that the VIX is, the bigger the higher the put premiums would be. And that actually means that the stock would have to go up more just to break even. Now, the investor could choose that, but that might be a lower probability-based strategy. Okay. And they could do that if they wanted to. We're trying to do strategies that might be a higher probability than maybe that. Now, if the VIX is higher, the side of the trade that's collecting more premium is the short call. Okay. Now, why is it not more even? Well, it's because we're kind of stretching the upside. Okay. We want to try to have a higher potential upside. And why is the put more expensive? Well, because the put strike is closer to where we're buying the stock at. Okay, that's why it's kind of a little different. Most of the time in our examples, it would be more of a zero cost collar. Now, what I'm going to do is here, so trade number, I think 3 here, or 2, is going to be that we're doing a collar strategy. Now, in this strategy, is the investor trying to go for 100% of the max gain? Not necessarily. Trying to go for 80% of it. Okay? If there's 80, let me just write it out so we're clear. In the first 10 days, if the investor could get 50% of max gain, okay, in the first 10 days. If there's more than 20 days plus, if they had 65% of the max gain, wow, that's a really good trade. And what we would say is if we can get 80% of the maximum gain ever, okay? The only way we get 100% is you got to go all the way to expiration, or the stock has to go way above the strike price of the short call, okay? Not likely. So the only way you get the 100% typically, you got to go all the way to expiration, okay? Now, what I'm going to do in this case, let's go confirm and send. Now, notice here, there's not a commission to buy the shares. The commission is on the option. And what you're now going to see, a cost of number 2, including commissions. 65 cents to sell the call, 65 cents to buy the put. Okay? Now, yeah, so Thank you for that. Yeah, so the reason I was kind of just thinking trade number 2 or 3, we did the Apple short put vertical in the margin. Second trade, you could say is slightly different. Apple in the IRA, that was a long call vertical. And the third trade here was actually SHOP, was a caller strategy. Okay, now does this have a defined risk? Yeah, it sure does. And if we put that, because there's been a question on this, let's address this. James, what does this trade look like on the risk profile? Okay, well, I'll tell you exactly what it looks like. Okay, so if we put this on the risk profile, we know on the Analyze tab, if the investor buys the shares, this is just plotting the profit loss diagram of a stock. It's a diagonal line. Surprise? Maybe not. But if we actually pull this up and say, well, what does this look like? Why did you say this is like a long call vertical? It's because it looks like a long call vertical. Has a max gain cap to the upside, max loss to the downside, and the biggest thing that what we really want to know is, what is the delta? And when we look at this strategy and say, what is the delta of this position? Has a delta of 27. And if you look at all the other Greeks right here, there's not anything significant. So we said, if someone does a caller, what is the strategy really trying to focus on? Direction. Direction, direction, direction. But there's a cap on that direction to the upside, and there's a cap or a floor to the loss as well. All right? All right. Any questions there? Now, I want to kind of, in the about 3 or 4 minutes we have left, let's kind of just fast fire through a couple stocks where the investor might look for some examples. Now, number one is one of the stocks that's, for example, kind of done like a little, I mean, it doesn't have earnings, where it kind of has a pennant pattern. Now, Rachel actually teaches a class on price patterns. And this one has kind of gone pokey to the upside here, as some people say, okay? Does it have like a divergence? I mean, are we going to say it's bad if we don't have a double bottom? No, not necessarily. It kind of more has your classic tilted up W pattern. MACD has finally gone green. It's good to see it back. Kind of wondered if it was ever going to come back. But actually, that one actually hit a brand new high. Now, keep an eye. If we got CMI going up, you got to ask the question, well, what about Kitty Cat? Well, Caterpillar's trying to get a little push. Is CAT at a horizontal? Yeah. Is CAT actually showing maybe like a divergence? That does not look like a divergence. So CMI looking a little stronger. If we say Cummins, CAT, probably would be remiss not to say Deere, and Deere is actually going to earnings. That's why some investors might kind of look at Cummins over, let's say, Deere. Now, I'm also going to kind of bring up, like when we look at gold, gold is kind of still holding in that horizontal range where it was about a week ago. But the one I want to look at just real quick is, speaking of one that's holding that trend line, FedEx. FedEx is kind of barely pulled back. Did it pull back? Yes. Friday, it ended up near the high of the week. Okay? So this is kind of the first test is, does the investor always have to buy stocks on the pullback at a horizontal support? No. You might just look for stocks that didn't have much of a pullback. It's not to say they didn't pull back, but they maybe just ended the week well, or they're kind of trading up in the high of the week's range. FedEx is also maybe trying to get back up inside that old channel. That's one that maybe investor might keep an eye on. If we say FedEx, we might say Brown. Is Brown moving, or UPS? Not as much as FedEx. So FedEx or Memphis leading Louisville. Okay, not Louisville, it's Louisville. Now, if we take a look at Avgo, what is going on with Avgo? Did it pull back to a horizontal support? Well, I think we could say that. Is it a divergence? It's a little, not as crystal clear, but you do kind of see a little turn there. It was a little all over the place right there. But is this divergence, that low point right there and the low point right there, is that showing a divergence? Avgo, Broadcom, showing a divergence. That is kind of more classic. Price falls down to horizontal support. One, do we have a bullish MACD divergence? As of today, starting to show that. And then actually with that, do we kind of see the the methodology? The one, the crossover, two, and the 20-period moving average, three. There it is. Could it go up? Some investors might be looking for that. But again, it goes back to, if the investor said, look, I don't just do stocks, I do other things, you might say, look, this is why some investors might use some derivatives where there's a max gain built into the trade outside the stock going to zero. That's up to you to decide if that's something you would consider. Now, I'm out of my time here today. We did 3 trade examples or 2 tickers. Now, I also want to kind of address some of those questions here today. Yes, I agree with you, Bill. There's many stocks here that are trying to get trend 2. Yes. And I want to kind of repeat. Now, by the way, last week, many people's screens were not trend 2 and trend 3. It was 1, 1, 1, pretty much all the way down. Not taking any vacation until next May. Does that mean the market could go up? We'll find out. So with that said, I'm out of my time here. Stay tuned for Cameron May coming up next. The material that we actually talked about here today was based upon your feedback on X and also just some comments in the chat as well. So hopefully you appreciated that. Thanks to Rachel as well for teaching, for helping me in chat here today, and also follow her classes right on the coaching channel as well, and also on X. Now remember, with what we discussed here today, it was done for example, illustrative purposes only. Remember, with what we discussed, all investing has risk. Stay tuned for our next webcast coming up, and don't forget to subscribe. Click the thumbs up button as well. That way others could actually follow this class on YouTube. Take care. Bye-bye.